Welcome to the Security Finance 401k Plan, a program designed to help you prepare for a secure retirement. One of the advantages of employment with Security Finance is the exceptional benefits program we offer our employees. The 401k plan has become the cornerstone of our strategy to attract and retain valuable employees. This short video explains some of the important features of the plan and how you can take full advantage of this important aspect of your benefit program. How you become eligible, how to enroll, and the investment of your contributions are but a few of the important highlights included in this material. So sit back and relax. Make notes of any questions you may have. The professionals with the Newport Group, our financial advisor, or PenServ Plan Services, the record keeper, are available to assist you with your questions. I see you're smiling. You're probably thinking, I'm only 28 years old. I have 35 years to worry about retirement. So, when do you plan to begin? When you're 20 years from retirement? Maybe 4 or 5 years from now? Well, we have some great news for you. You're one of the lucky ones. You're young, and time is on your side. The longer you wait, the more costly it will be in the future. The investments in your plan will grow, but it takes time to accumulate sufficient assets to provide a comfortable retirement for 25 years or more. Waiting just 1 year will make a significant difference. We'll come back to these numbers shortly, but based on some assumptions we've used, waiting just 1 year could cost you more than $40,000 in retirement benefits. Now you understand this is a good idea. But you have questions, right? How does it work? What if I don't work for Security Finance until I retire? Where do I get more information? Let's take a look. The plan consists of a number of components that form your retirement program. Contributions can come from various sources, and each of these sources are maintained separately in your account. We'll show you a little more about that later on. Employer contributions may be subject to a vesting schedule based on your years of service with Security Finance. How your contributions are invested is a topic you should understand when you join the plan. And the most important question of all, when and how can I withdraw from my account? Let's begin by looking at the eligibility process. Employees who are 18 years of age and who are credited with a year of service are eligible to join the plan on the next entry date. The 12-month period begins with your date of employment and ends on the anniversary of that date. During that time, you must be credited with 1,000 hours of service. After you complete a year of service and reach age 18, you may join the plan on the next January, April, July, or October 1st and begin deferrals from your wages. Your employer matching contributions will be applied as soon as your deferrals begin. Once you complete a year of service and reach age 18, you will also become eligible for the employer's discretionary contribution on the next January or July 1st. Contributions come from a number of sources. First and foremost, a 401k is a retirement program sponsored by your employer. Both you and Security Finance are able to make contributions to the plan. During the enrollment period, you're able to direct a portion of your wages to the plan. As your deferred wages are applied to the plan, Security Finance matches your contributions. And from the profits you help generate, Security is able to make additional non-elective contributions to all employees who meet the requirements.
Once you've met the requirements for joining the plan, you must enroll and direct Security Finance to withhold from each pay. You may elect to defer up to 75% of your earnings, not to exceed the annual limit published each year by the Internal Revenue Service. For 2016, that limit is $18,000. If you will reach age 50, on or before December 31, 2016, you may defer an additional $6,000. This additional amount is known as a catch-up contribution, and you can begin to defer the additional amount beginning on January 1, 2016.
Your plan allows you to elect deferrals on a traditional pre-tax basis, or you may select an after-tax Roth. While a Roth does not provide a tax benefit at the time it's withheld from your pay, you may be able to receive tax-free distributions from your plan if you meet certain requirements. Regulations require that payments from your Roth will be tax-free if you have attained age 59 and a half at the time the distribution is made, your Roth account meets the 5-year participation rule, you're disabled, or the payment is made in case of your death. Before making this election, you should consult with your tax advisor. This is a complex decision, so be certain you understand these rules. When you elect to make salary deferrals to the plan, Security Finance will match 100% of the first 3% and 50% of the next 2% of your contributions. The plan also allows Security Finance to make discretionary contributions to the plan, whether or not you choose to participate with your own deferrals. The discretionary contribution can be zero or a higher amount based on the company profits you help to generate. You have to agree, this is a great plan. So, how much should I contribute? Experts all agree. Employees need to save 10% of their wages for retirement. When preparing a budget, this item should be high on your priority list. Think 10% is too much? Let's look at some numbers. First, we need to make some assumptions. You let us know you're 28 years old, which leaves 37 years if you elect to retire at age 65. Your current annual salary is $38,000 and you're paid bi-weekly. We'll also assume your compensation will increase by 3% each year and you've selected a moderate portfolio that yields on average 4.5%. If you elect to contribute 10% of your wages, you'll receive a matching employer contribution of 4%. That's an immediate 40% rate of return on your investment. Let's assume you begin to participate when you're 28 years old. You work for Security Finance until you're 65 years old, and the matching contribution to the plan remains constant. We'll also assume your investments earn on average 4.5%. At age 65, your 401k account could be worth more than $690,000. Now, let's look at the same example, but in this case, Security Finance makes a discretionary 2% contribution to your plan each year. That could increase the value of your account by more than $100,000 and provide a great nest egg for your retirement years. Not many employers provide a benefit like that. The advantages of the plan don't stop here. The Security Finance Retirement Committee employs a professional investment manager to search for and select high-quality, low-cost mutual funds for your account. By consolidating all the accounts into one, the plan is able to purchase mutual funds that may not be available to you if you were to invest in a personal investment account, such as an IRA. In addition, the funds are monitored and reviewed quarterly to ensure the standards established by your retirement plan committee are maintained. The current fund list can be found in your enrollment guide. As you select from the list of individual investments, it's important to understand a few basic facts. The first is to diversify your options. Investment experts recommend a mix of funds that includes a number of asset classes. For example, investing in one fund or one class of funds could prove risky. Selecting funds from several asset classes will help to insulate your account from market fluctuations. This process is known as asset allocation, and you should be aware of this concept. The next point relates to risk. When you invest your contributions in mutual funds, there is a potential for the share price to increase or decrease. In fact, some funds have characteristics that cause the price to fluctuate more than others. Risk can be described as the possibility of losing a portion of your 401k contributions by investing in a fund with a value that can increase or decrease with market conditions. The risk associated with an investment option is generally associated with the potential for a greater rate of return. For example, if you invest your contributions in a money market fund, the rate of return is expected to be low. However, there is little chance that you will lose your original investment in the fund. Rising and falling investment markets don't impact the share price of this option. Equity funds are quite different, and market activity impacts the value of contributions invested in this category. Determining your tolerance for risk will help you select the most appropriate funds for you. Risk can be different for everyone. You may not worry if your 401k account loses 2 or 3% in a quarter, while your coworker may lose sleep over such an event. As a result, it's likely you won't choose the same investments your coworker will select. To assist participants in defining their risk level, the plan website provides an investor profile questionnaire that lists a number of questions specifically designed to help you understand this process. There are a number of factors to consider when selecting investment options, and this information will provide a better understanding of the elements to consider when evaluating your choices. So, use the questionnaire, answer the questions to the best of your ability, and your choice of fund should suit your comfort level. The other important factor you should consider is the process for rebalancing your account. For example, you may choose 5 investment options during the initial enrollment and allocate 20% to each fund. Over time, market changes can increase the value of one account and decline in another. As a result, the actual ratios among the 5 funds may become disproportionate. Experts recommend that investors periodically rebalance their accounts, realigning the allocations to the original percentages. As your account grows, you can add funds to your mix and follow the same basic process. And make it a rule to check your account on a regular basis. Put a reminder in your schedule and devote some time to reviewing your progress. Now, let's take a look at another feature of your plan, the vesting schedule. Vesting refers to the portion of your employer account that belongs to you if you should leave Security Finance for any reason. The balances in your account are subject to market value fluctuations and may increase or decrease based on your investments. The value of your salary deferral account, as well as the employer's matching account, always belongs to you. Your employer non-elective account, however, will not be vested until you have completed 3 years of service. This chart demonstrates the application of the vesting schedule. As you can see, deferrals and match account balances always belong to you. But the employer non-elective account requires participants to be credited with 3 years of service to become 100% vested. As you'll recall, a year of service is defined as a 12-month period during which you are credited with 1,000 hours. The first calculation period begins on your date of employment and ends 1 year from that date. In the second year, the period shifts to the plan year that begins during your first year of employment. Once you're credited with 3 years of service, you'll be fully vested in your entire account. As we mentioned previously, the purpose of the plan is to create a source of income during your retirement years. But what if you leave Security Finance and work for a new employer? Or what if you experience a severe financial need while you're employed? You'll be eligible to withdraw from your salary deferral and employer match accounts once you've attained age 59 and a half. At that time, you can receive a direct distribution of those balances or roll the proceeds from your plan into an IRA or other qualifying plan. Any rollover balances are available at any time, but your employer non-elective account is only available when you retire. If you elect to receive the benefits directly, the required income taxes will be withheld from your distribution. An in-service withdrawal allows you to receive funds from your 401k account without terminating your employment with Security Finance. The withdrawal can be rolled to an IRA or other qualifying plan, or you may receive the amount as a direct payment subject to income taxes. You're limited to one in-service withdrawal per year. You may also qualify for a hardship payment, but if you're under the age 59.5 at the time of the payment, you'll face a 10% early withdrawal penalty, in addition to the ordinary federal and state income taxes. Additional details are available in the SPD located on the Forms page of the plan website. Your plan allows a hardship for the purchase of your primary residence, money for burial or funeral costs of a dependent, money for repair of damages to your principal residence that occurred as a result of a natural disaster, payment of higher education expenses for you or your dependent, money to prevent eviction or foreclosure from your primary residence, and payment of certain medical expenses that aren't reimbursed by your insurer. A hardship distribution is not automatic. You must provide specific documentation to support your hardship application. Check with your plan administrator for details. If you terminate employment with Security Finance, you'll be eligible to withdraw your vested balance. Your plan offers a number of withdrawal options, including a direct payment to you, a rollover to another employer's retirement plan, or a rollover to an IRA. If you elect a direct payment to you, you may still roll over the payment within 60 days. However, IRS regulations require that 20% be withheld from your distribution at the time the payment is made. If you decide to roll over the amount, you can include monies from your personal assets equal to the tax withholding, and based on your tax situation, a refund may be available when you file your personal tax return. A direct rollover to an IRA or another employer's plan is not subject to the 20% withholding when the distribution is made from your Security Finance account. A rollover will also allow your retirement program to continue growing on a tax-deferred basis. If you terminate employment and your account balance is less than $5,000, the plan requires that you receive a distribution of your vested benefit. But that may not be the best option. With time and tax-deferred compounding, even small amounts can grow large, and rolling your distribution into another retirement account would help to achieve your retirement goals. When you retire, you have to decide what to do with your 401k account. The plan offers a number of options. You can leave your money invested in the plan if your balance exceeds $5,000. You can take a lump sum distribution, or you may choose to roll the money into an IRA or another qualifying plan. If you elect a lump sum payment, income taxes must be applied on your distribution, which can be a big bite out of your nest egg. You may also keep your money growing tax-deferred by leaving the money invested in the plan. Experts generally recommend you use taxable accounts first and postpone withdrawals from your tax-sheltered plans as long as possible. So, if you have other accounts to live on, you may postpone distributions until you're 70.5. At that time, you'll be required to begin receiving payments. You may also roll over your balance to an IRA. This may offer greater investment choice and control. But if you're happy with your 401k's investment menu, keeping your money in the plan may be a viable option. If you prefer regular payments during your retirement, you can roll over your account with the proceeds from your 401k plan and purchase an annuity from an insurer of your choice. These payments can provide a guaranteed income for the rest of your life. You don't have to worry about managing your account, And if you buy an annuity with survivor benefits, your spouse could receive a portion of your payments after you die. These elections can be complicated and can impact your taxable income. We recommend that you consult a tax advisor before electing a distribution option from your plan. There are many more benefits to your Security Finance 401k plan, so check out the website, talk with your human resources contact, and learn all you can about this great option. Make plans for your retirement. Don't deviate from your plan. Sit back and watch your account grow. Over time, you'll be glad you did. If you have any questions about your account or the plan, please check with our record keeper, PenServe Plan Services. During normal business hours, simply call 803-354-5004 to speak with a Security Finance representative.